like when I would hear about this in the past, like especially as somebody who was like fresh out of school or like who didn't focus on business classes or econ in their college career, I was like, what the hell does it mean that the yield curve is inverted? You know what I mean? Like you don't understand what that really means, like in real context. So I'm glad that we're kind of talking about this because I'm sure there's a lot of people who are in similar situations where they're like, okay, I know interest rates are like the talk of the town, and every other day it feels like, we're seeing discussions of bonds or rates or yields in traditional financial media, but like, what does that actually mean? And why is this so significant? So I'm glad we're kind of taking it back and taking a minute to explain that today to everybody.
Yeah, because it's a funny thing. You're exactly right. Like the first time I was introduced to the yield curve and inversions, I think most people know it by like, oh, it's bad for the economy. And it's like, even before knowing technically what a yield curve inversion is, you just kind of understand it as this auspicious sign of like bad things to come for the economy. And I mean, to that notion's credit, the history that we're going to look through today of yield curve inversions dating back to the year 2000, they have occurred most times in tandem with a little bit of a stock market crash, but they don't necessitate a stock market crash, Katie. From a technical standpoint, yield curve inversions simply, all they mean is short-term yields have surpassed long-term yields. The funny thing is if you put a magnifying glass on the US Treasury yield curve, which you actually very easily can if you go to one of my favorite places is treasury.gov. They've got historical data on, 1 month T-bills all the way out to 30-year Treasury bonds. At any given moment, you might see a little, 1 or 2 basis point inversion between the 3-month and the 6-month bill. But what we're really looking at in terms of inversions, Katie, as everyday people and practical traders is something substantial like the 2-year versus the 10-year. That's where if you were to read a headline of like yield curve inversion spooks markets, it's almost definitely going to be those 2 major benchmarks, right?
Yeah, exactly. I mean, and that's funny though, because like you gotta look at it like like you said, you can go in and look under the like with the magnifying glass, but you can also, and realistically we should look at it on like a little bit of a longer time frame or with more maturities considered rather than just only short terms or only long terms.
Exactly right, because a lot of that funkiness will be just like, honestly, like some people will reach out to me every once in a while and be like, did you see that inversion between, the 3-month and the 6-month T-bill? It'll be like, that's kind of just like banking BS, like it's real and it could be a sign of further inversions, but stuff like that is usually like, the banks and the Fed, there's just some wonkiness occurring right now. Maybe the Fed is hiking and certain, Treasury bills and notes aren't keeping pace, whatever. But when you see something that is like we're seeing recently, the 2-year versus the 10-year, something that really encapsulates the bulk of the yield curve, when something like that is near inversion or inverted, that's when it really becomes a news story, becomes a great trade to look at, and becomes something that could affect all your other assets and different parts of your life. Another way to look at this from a more practical trader standpoint, Katie, is first of all, using the S10Y and S2Y futures or indices that hopefully your brokerage and platform has. Tastyworks absolutely has this stuff. And you can see here that the difference between that 10-year minus the 2-year having gone from $16, which is 1.6%, all the way down to where that chart now is quoted at $0. That difference, when it turns into negative territory, that also signals inversion. It's the same thing. One doesn't happen and then the other happens, but it's just a different way to view it, right?
Yeah, exactly. And I mean, if you just think about it like from a more elementary perspective, it's like, okay, then what's the incentive to like hold something, or like why, like with something with longer maturity, like there naturally should be a higher interest rate or yield associated with it. So even just thinking about it in that perspective, like it helped me understand like, okay, so what's the point of having a later dated duration?
Exactly. Great practical point, because you'll see here as I add now more than 2 decades of data on top of this same relationship here. This is once again the difference between the 10-year and the 2-year yield. Adding all this data, you can see almost all of the time, save for, maybe 2 or 3 percentage points worth of this data set, almost all of the time, the spread is positive. A lot of the time to the tune of 1 to 3% worth of difference between that 10-year and the 2-year. And you're exactly right. Most of the time, I should be getting paid more interest for, Katie, giving you money for 10 years versus 2 years. It from a practical standpoint makes sense that the average between the 10-year and the 2-year is 1%, 1.5%, depending on the time window you're looking at. But actually, the last time the yield curve went inverted, you were spot on, as we were looking at markets earlier. It was 2019, Katie. The funny thing, this doesn't always happen this way, but it was inverted for all of 3 days. Do you even remember when it flashed inverted back in 2019?
I was literally just trying to search on the Tasty Trade website to see if I can put any type of context around that. And you can see there are definitely segments where you and Pete are talking about it, or me and Pete are talking about it. But long term, I have no recollection of that, in terms of how I felt or what I was thinking in the moment.
And why we talk about it and why we love to look at it is look at that after those couple of days. Of course, like I say, it didn't flip a switch and then immediately afterwards it skyrocketed. But in the months that followed, that spread gets all the way back to 1%, 1.5%. And that's why we look at trading the other side of these inversions. Now, other parts of history where we've gone inverted have lasted a little bit longer. Back in 2006, 2007, we did spend a little over a year there and got down to negative 0.2%. And then the last one in history here, Katie, less than a year worth of time spent inverted back in 2000 and got down to negative 0.5%. So a couple of takeaways before I want to get your thoughts on these other historical pieces, and then we can get out of here, is we can spend a little bit of time inverted. We don't tend to get very inverted. You don't see this chart showing, positive 3% of difference and negative 3% of difference. We have historically been tapped out at, negative 0.25% to negative 0.5% there. And I mean, you see for yourself, the average value is in positive territory, probably around 1 to 2%. That's why we like to get on the other side of these things. Do you have any other takeaways? Another one might be that it's also auspicious that it's early 2000 that we see inversion. 2006, 2007, we see inversion. 2019, we see inversion. Not that this inversion, I think, predicted the pandemic that would occur, but it does coincide with some stock market crashes. Do you have any last takeaways for the history of yield curve inversions?
I just think obviously we're bringing this up for a reason, and historically long term it's not necessarily meant to stay here. So if you can think about putting on a little bit of a steepener style trade, or a trade where in this instance, if we're talking about the 2s and 10s, maybe you're selling that 2-year and buying that 10 in the hopes that we kind of widen back out again, right? That's how you would set this up. That might be worth a consideration, because as we've seen over 22 years of history, happened 2 or 3 times. Doesn't typically last a very long time. Not to say that this one couldn't, but it's an opportunity, and it's definitely something I'm going to have closer eyes on for the next, couple of weeks, if not longer.